11 questions 50% CFA Level 1 candidates fail to grasp, including 4 crucial ones at the end. Liquidity ratios. Question 11. Which statement best summarizes the analyst's reasonable conclusions on payment abilities? A firm X current ratio of 4.0 shows greater liquidity than firm Y at 1.22. But firm Y has stronger solvency, with debt to equity of 30% versus firm X at 150%. B firm X current ratio of 0.25 shows lower liquidity than firm Y at 0.82. And firm X has weaker solvency, with debt to equity of 150% versus firm Y at 30%. C firm X current ratio of 4.0 shows greater liquidity than firm Y at 1.22. And firm X has stronger solvency, with debt to equity of 150% versus firm Y at 30%. Correct answer: A. Liquidity is measured by the current ratio, calculated as current assets divided by current liabilities. Firm X's current ratio is 4.0, while firm Y's is 1.22. Therefore, firm X has greater liquidity. Solvency is measured by the debt to equity ratio, calculated as total debt divided by shareholders' equity. Firm X's debt to equity ratio is 1.50 or 150%, while firm Y's is 0.304 or 30%. Firm Y has stronger solvency since its ratio is lower. Question 10. Comparing year 5 with year 1, which of the following best describes a reasonable conclusion about the company's liquidity? A liquidity deteriorated as indicated by a decrease in its current ratio from 0.97 to 0.88. B liquidity improved as indicated by an increase in its interest coverage ratio. C liquidity deteriorated as indicated by an increase in its debt to assets ratio. Correct answer: A. Liquidity decreased as the current ratio dropped from 0.97 to 0.88 due to current liabilities growing faster than current assets. B incorrect. Interest coverage measures solvency, not liquidity. C incorrect. Debt to assets ratio data is missing. Question 9. A company provides the following data from its balance sheet in thousands of dollars. Cash and cash equivalents, $2,500. Short-term investments, $8,000. Accounts receivable, $185,000. Inventory, $210,000. Prepaid expenses, $15,000. Total current assets, $420,500. Total current liabilities, $310,000. The company's quick ratio is closest to A 0.63, B 1.36, C 0.03. Correct answer: A. Quick ratio calculation. Quick ratio equals cash plus short-term investments plus accounts receivable divided by total current liabilities. Quick assets: cash and cash equivalents plus short-term investments plus accounts receivable. Quick ratio value 0.63. A quick ratio of 0.63 indicates potential liquidity risk, as the company has less than one highly liquid asset for every current liability. Question 8. All else held constant, if a company improves its collection efforts, leading to a decrease in its average accounts receivable, the company's cash conversion cycle will most likely A. Increase, B. Decrease, C. Remain unchanged. Correct answer: B. Definition of CCC: a key liquidity metric showing the time taken to convert inventory and accounts receivable into cash. CCC formula: CCC equals days inventory outstanding, DO, plus days sales outstanding, DSO, minus days payable outstanding, DPO. Improving collection efforts decreases average accounts receivable, leading to a lower days sales outstanding, DSO. All else constant, DO and DPO remain unchanged. Thus, the only change is the decrease in DSO, which directly reduces the CCC. A lower CCC is favorable as it indicates the company converts its working capital into cash more quickly, improving liquidity and reducing the need for external financing. A. Incorrect. Faster collections decrease DSO and CCC. C. Incorrect. DSO changes necessitate CCC formula adjustments. Question 7. A retail company reports the following financial data for the year in $ millions. Sales, 6,500. Cost of goods sold, 4,200. Purchases, 4,350. Average accounts receivable, 820. Average inventory, 950. Average accounts payable, 280. Assuming a 365-day year, the company's cash conversion cycle in days is closest to 104 days, B 128 days, C 152 days. Correct answer, A. Inventory management. Days inventory outstanding is 82.56 days. Accounts receivable management. Days sales outstanding is 46.05 days. Accounts payable management. Days payable outstanding is 24.33 days. Cash conversion cycle definition. The time it takes for a company to convert its investments in inventory and other resources into cash flows from sales. Cash conversion cycle calculation. Days inventory outstanding plus days sales outstanding minus days payable outstanding. Cash conversion cycle result, 104 days, indicating moderate efficiency in working capital management. Question 6. Based on the data provided, which of the following is the analyst most likely to conclude? The company's liquidity has improved due to more efficient management of inventory. B. The company's liquidity has improved due to faster collection of its receivables. C. The company's liquidity has deteriorated due to taking longer to pay its suppliers. Correct answer, A. Inventory management efficiency. Days of inventory on hand, DOH, measures how quickly a company converts inventory into sales. Positive trend in inventory turnover. DOH decreased from 50 days to 38 days, indicating faster inventory sell-through. Financial impact. Improved inventory management leads to better cash flow and liquidity. DSO definition. Measures the average time to collect cash after a sale. DSO trend. Increased from 28 days to 35 days over 3 years. DSO implication. Negative trend, indicating slower cash collection and potential liquidity issues. Definition of DPO. Measures the average time a company takes to pay its suppliers. Impact of DPO on liquidity. An increase in DPO is generally positive for liquidity as it indicates the company is holding onto its cash for a longer period. DPO trend. Increase from 40 days to 45 days, suggesting improved liquidity due to delayed cash outflow. Cash conversion cycle, CCC definition. CCC equals DOH plus DSO minus DPO, measuring the time to convert inputs into cash. CCC improvement. CCC decreased from 38 days to 28 days, indicating improved liquidity. Days of holding, DOH impact. Significant decrease in DOH. 50 to 38 days contributed to the improved CCC. B. Incorrect. DSO increased from 28 to 35 days, indicating slower collections. C. Incorrect. Increased DPO and improved CCC indicate improved liquidity. Question 5. A company provides the following financial information for the current year. Sales, $850,000. Cost of goods sold, $595,000. Average accounts receivable, $125,000. Average inventory, $95,000. Average accounts payable, $70,000. Assuming a 365-day year, the company's cash conversion cycle in days is closest to 69.1 days. B. 91.5 days. C. 102.3 days. Correct answer: A. Cash conversion cycle is calculated using days inventory outstanding, DO, days sales outstanding, DSO, and days payables outstanding, DPO. Days sales outstanding, DSO, 53.7 days. Days payable outstanding, DPO, 42.9 days. Cash conversion cycle, CCC, 69.1 days. Question 4. 4 crucial questions. An analyst calculates that a manufacturing company has a defensive interval ratio of 25 days. This result most likely indicates that the company: A. Is highly efficient in managing its working capital. B. Can cover its daily cash expenditures for 25 days using its liquid assets. C. Has sufficient long-term assets to cover its obligations for 25 days. Correct answer: B. Ratio definition. A liquidity ratio measuring how many days a company can sustain operations using only its most liquid assets. Ratio calculation: cash, marketable securities, and receivables divided by daily cash expenditures. Ratio interpretation: a higher ratio indicates greater liquidity and a company's ability to cover expenses for a longer period without additional cash inflows. A. Incorrect. Working capital efficiency is measured by activity ratios, not liquidity ratios. C. Incorrect. Solvency ratios assess long-term obligations, not relevant to DR. Question 3. An analyst notes the following changes in a company's liquidity position. The cash ratio declined from 0.9 to 0.7. The quick ratio improved from 1.5 to 1.7. Based solely on this information, which of the following current assets most likely increased from last year to this year? A. Inventory. B. Prepaid expenses. C. Accounts receivable. Correct answer: C. Cash ratio trend declined from 0.9 to 0.7, indicating a decrease in cash and marketable securities relative to current liabilities. Quick ratio trend improved from 1.5 to 1.7, suggesting an increase in quick assets, cash, marketable securities, and receivables relative to current liabilities. Cash ratio trend declined due to a decrease in cash and marketable securities. Quick ratio trend improved despite a decline in cash and marketable securities. Accounts receivable change increased significantly, offsetting the decline in cash and marketable securities and improving the quick ratio. A. Incorrect. Inventory changes don't affect the quick ratio. B. Incorrect. Prepaid expenses are excluded from the quick ratio. Question 2. A company reports the following information from its balance sheet in pound symbol thousands. End of current year. Cash and equivalents, 120. Short-term investments, 80. Total current liabilities, 400. End of prior year. Cash and equivalents, 100. Short-term investments, 100. Total current liabilities, 400. The change in the company's cash ratio from the prior year to the current year is best described as A. An increase. B. No change. C. A decrease. Correct answer: B. Cash ratio definition: cash and equivalents plus short-term investments divided by total current liabilities. Prior year cash ratio, 0.5. Current year cash ratio, 0.5. Question 1. An analyst gathers the following activity ratios for a retail company. Payables turnover, 4 times. Receivables turnover, 8 times. Inventory turnover, 5 times. Assuming a 365-day year, the company's cash conversion cycle is closest to 27 days. B. 64 days. 118 days. Correct answer: A. Cash conversion cycle definition: The time between outlaying cash to purchase inventory and collecting cash from customer sales. Cash conversion cycle calculation. Days inventory outstanding plus days sales outstanding minus days payable outstanding. Cash conversion cycle result, 27.38 days.